JFE Holdings, the Japanese listed steel conglomerate, has recently announced that it may lose money this year and that it will close some of its plants. They expressed disappointment because profit has been on the rise since 2014 when the CEO took over. We've had a close look at the accounts and think they've been completely misrepresenting their results, so much so that it's close to being fraudulent. We think that over the last few years real margins have been falling, and had the business been maintaining its assets properly, it would have actually been losing its money. The problem for shareholders is that management has little incentive to change its ways, and it looks to us as if JFE is slowly but surely heading into bankruptcy. But before we go on, I must remind you that under Hong Kong SFC regulations, we can't make stock recommendations to the public, and none of what follows should be taken as investment advice. JFE recently announced a restructuring and explained that they would be booking a $2 billion impairment charge, i.e. their assets were overvalued on the balance sheet. They will also close facilities in Keihin and Chiba, which will cut production around 13%. They hope that this will return the company to profitability, but we think the rot runs far deeper than this. JFE appears to us to be structurally unprofitable and certainly unable to fund itself. I will use our governance, accounting, risk and peer performance approach to try and explain exactly what the problems are. Governance. JFE is controlled by long-term employees with very good salaries and pensions, but only very modest equity stakes. They have lots of reasons to maintain the status quo, but very little reason to care about shareholders. They have some outside directors, but given the share price performance at the companies these people manage, we're not hopeful that these directors care about shareholders much more either. They've clearly heard about ESG practices, and their response has been to appoint a woman to the auditing and supervisory board. But they acknowledge that in Japan these boards are fairly toothless, and in many cases are simply supposed to do as they're told. In a similar way, the remuneration scheme talks about performance-based incentives, but the targets are easy to manipulate and ignore risk, which is something of a concern for a company whose liabilities just keep rising. Even when they do make the grade and hit their targets, most of their compensation is in cash, not stock. Even so, they regularly fail to meet their business targets, but no one ever gets sacked. We think one of the reasons for this is because the directors are protected by a poison pill that completely prevents outside influence, especially from American hedge funds. Accounting. Mr Kakigi took over after fiscal year 2013. Since then, depreciation has been markedly lower as a percentage of sales, a percentage of assets, and in absolute numbers. However, you can see from the slide, Capex, which was lower than depreciation, has become consistently higher, even though revenue is flatlined. This seems to us to be a classic case of someone under-depreciating simply to flatter profit, and the $2 billion impairment would seem to confirm that values were too high and depreciation hasn't been high enough. But it's worse than that, because the directors actually acknowledge they've been underinvesting. Capex and depreciation should have been nearly 50% higher just to maintain the status quo. They also admit that they will struggle to fund this, and they're going to fund it by manipulating their working capital. This matters because if you make depreciation equal to Capex, the reported profit margin falls to under 2%. Match depreciation to the proper Capex level and JFE is now structurally loss-making. As a cross-check, we compared JFE to its mature market peers, and it's quite clear that their depreciation rate is the lowest in Japan and amongst the lowest elsewhere. In case you're wondering how they can get away with such judicious accounting, the accounts reveal that not only do they pay very modest fees to their main auditors, they also have multiple different auditors for their offshore companies. This puts management in an incredibly strong position to ensure that the accounts deliver exactly what they want to produce. As long as they're then legally defensible, even if they don't reflect the business reality, directors are safe. Performance. JFE's reported pre-depreciation operating margins are better than its Japanese peers, but they are less than 2/3 the margins made by its successful overseas competitors. However, correct for Capex, the numbers look a lot worse. The Japanese steel companies are now barely breaking even. If we corrected for JFE's underinvestment as well, it would have the lowest margins in the world. This is why, for all its reported profits, JFE is bleeding cash. In most recent years, it's had to sell assets or borrow to fund its dividend payments. COVID is a problem everywhere, but it shouldn't have mattered in JFE's latest results because outside China, car sales only started to slow at the end of March. The real impact started in April, when most car makers started to cut production. This year it's going to look very different. Fixed costs have been around 20% of sales, with variable costs around 75%. If deliveries fall 50% for 2 months, which may be generous, COVID will cost JFE 40 to 60 billion yen. If revenue for the rest of the year bounces back but drops due to production cuts, JFE will not be able to cover the cost of its care and maintenance capex program. Longer term, the problem is that Japanese production is in decline. It's also very reliant on exports, leaving it vulnerable should the much larger Chinese steel industry start to ramp up its relatively small export trade. Even the company is forecasting tough times, but presumably if they're cash flow negative in the good times, they will find it very difficult to change this in the bad times. Debt is already a problem and their balance sheet is starting to look quite ugly. Since Mr Kakigi took over, they've gone from having a positive short-term net assets to having 700 billion yen of liabilities. We think that this may rise by another 200 billion yen during the current accounting year. Rising debt means that although JFE's share price is falling, its enterprise value is rising. Despite this, the credit market has yet to really pay attention. We wonder how long it will be before people realise that their debt can never be repaid. If you want to dig a little deeper, visit the JFE page on Bucephalus.com using the link below. There you can see the questions we think investors should ask and download recent filings where we've highlighted some of the key points. To keep up to date with our reviews, subscribe to our channel or send us an email. But before you go, please remember none of this should be taken as investment advice. We've sourced the facts from company documents, but the interpretation and conclusions are just our opinion. We provide these videos for education purposes to expose what we perceive to be creative accounting. They're subjective and should not be used as a basis for investment. Thank you for your time.